Hey, how you doing? And welcome to Livewise Buy Hold Sell. I'm Ellie Selby, and I know I say this a lot, but today we truly do have a very special one for you. We're joined by two Hall of Fame investors, meaning these are two of the best investors in Australia. We're going to be learning how they invest, where they see opportunities and risks today, as well as their top tips so you can be successful over the year ahead. To do that, I'm joined by Kourtis from Ellerston and Matt Williams from Airlie. Matt, I'm going to start with you today. What's something early on that really shaped who you are as an investor?
Yeah, thanks, Ali. When I first started, I used to think, the stocks were just these green little squiggly lines on a computer screen. But it took me a while until I realised it was all about management. Management is just so crucial to the success or failure of any investment that you make.
As in the management team, or your managing of the investment itself?
The management team. So, the really good management teams who can allocate capital in a really skillful and successful way can just end up having miraculous kind of stock returns.
In your view, what percentage of the ASX would have those kinds of teams?
That's a good question. Look, I think management's really improved over the 30 years I've been in the business in Australia, the management and boards. But you can get stung. You can still get hit by management who surprise you with a big change in capital allocation plans.
Over to you, Chris. What's something that you learnt really early on that completely changed the way you think about investing?
Well, Matt's certainly right about picking the right management team, but I've found some of my best investments over the journey have been where management have got it wrong or misstepped or made dumb acquisitions or pursued a strategy which for whatever reason short term has been value destructive and share prices correct sharply. And often I've found these companies that are in a transitional phase where management have got it wrong for whatever reason, industry dynamics change or they've just misread the outlook, and the market has clobbered some of these stocks. And some of the best investments I've made is some of those turnaround stories.
There's a little few breadcrumbs in that for your stock pick at the end of this episode, but we'll get into that later. Everyone makes mistakes. I've definitely made a lot of them. What's one mistake you made during your career and what did you learn from that?
How much time have you got? And how many would you like to talk about?
7 to 10 minutes.
Probably one of the biggest errors of judgment that I can think of, and I'd hate to think what performance it's cost me over the last decade plus, is probably not participating in the CommBank recapitalisation during the GFC in sort of late December 2008, early 2009, where they did that raising at sort of mid-20s. Market cap was probably 40 billion at the time. Fast forward today, we're at 220 plus market cap. The stocks just never look back. 3 times price to book, 23 times, and I've never owned it.
Wow.
So it's probably cost me. I shudder to think and shake my head on probably 700-800 points of underperformance, just that stock alone, not owning CommBank. Big error of judgment. Okay. Not going to buy it today, by the way. I'm quite stubborn at times.
Over to you, Matt. What's a mistake you've made during your career and what did you learn from that?
Yeah, look, like Chris, a million stock mistakes. Look, a really good investor, you're going to be wrong 40% of the time. If you're right 50-odd% of the time, you're a winner. You're going to outperform. So I've made so many. But I think if I boil it all down to, it's that great old saying, what hurts you is not what you don't know, it's what you know for sure that is wrong. And so many times I've made assumptions and then looked for evidence that confirmed those assumptions and ignored contradictory stuff. And it's that stuff that gets you. And so I think, being open-minded always, and not, I guess, Chris and I have been doing this for so long, not getting stuck in a rut and saying this is the way to do things. We've just got to, I think we've always been able to, learn and embrace new ideas and new thinking that keeps us away from those mistakes.
You both have decades of experience in markets. Matt, how are you thinking about some of those macro forces that are at play at the moment?
Yeah, I mean, I think, the macro looks pretty good, right? I mean, the Middle East, there's always trouble in the Middle East, and this is, at a higher level. But, you look at the US is cutting interest rates. China is doing something about their sluggish economy. Australia, hopefully will be looking to cut interest rates sometime early next year. So really, things are pretty good. The macro is very good. And it reminds me of a time maybe, the early 2000s where, the US were cutting rates, the house building, what became the bubble was really getting going, and things were good. I guess what's different from that time though to now is that valuations are a real high starting point here. Back in the early 2000s, the tech wreck had just happened, so they were building from a lower valuation point. Here though, valuations are high.
Right. Over to you, Chris. Do you agree? Does this time remind you of any other time in the past?
I think Matt's nailed it where he says, that's the risk, the valuation risk, where non-bank industrials now probably on about 24 times with very modest earnings growth. So valuations look stretched, but hopefully when we fast forward in 6 months' time and rates are coming down in Australia, we will get some earnings momentum. And China stimulus, it's real, it's happening. The Chinese market has gone ballistic. Property market in China has gone up 36%, in 5 nanoseconds. And we've had a 30% return in the Chinese market in the month of September alone, or 29.5 or whatever the number ended up being. And the market's gone on with it so far this month. So that's positive for Australian resource stocks. It can't hurt. So there's a degree of catch up. And if you look at some of the heavyweight resource stocks, your BHP, Rios, Fortescues of the world, they're still well down calendar year to date versus the industrial segment. So it's not all doom and gloom. I suppose I'm cautiously optimistic.
Love that phrase, and fund managers say that. You're obviously both Hall of Fame fund managers, which means you've made it to quite an illustrious list. What sets your strategy apart from the rest of the fund managers out there in the Australian market? What makes you a Hall of Fame fund manager?
Apart from the powerful suits that I wear. Look, well, personally, I can only speak for myself. I've always been a contrarian and a very high conviction manager. I'm never going to be called an index hugger. I do the deep dive into stocks, and not always right, but I will swing the bat, and I'll never ever be accused of being an index hugger. And as I said, some of my best wins have been turnaround stories where I go where no one else wants to go, where something looks toxic. It's a former market darling. It's fallen from dizzy heights to bombed out levels. And, I could go through a number of stocks where, literally I've picked an inflection point. And often if I'm guilty of anything, it's being early. But, I use this phrase, average down to get out of town. A lot of fundies will just say, look, we're wrong, we're dumping our position. This is causing us too much pain with clients. Well, that's never scared me. That's never scared me. And, often I'm zigging when everyone else is zagging. Okay,
over to you, Matt. What makes your strategy different from the rest of the pack? What makes you a Hall of Fame fund manager? Yeah,
a bit different than Chris. And I really admire Chris's, contrarian, attitude, and I see it, and we talk about the stocks that he buys. Obviously, Chris is a senior member of the Hall of Fame. He's a lot older than I am. I'm a much more younger Hall of Famer. But I guess what sets us apart is, basically, and it's a very boring kind of answer, but it's a disciplined application of the process over a long time, and we just try and stick to the process that I've been doing, and now myself and Emma Fisher at Airlie have continued on, and she's improved the process. We just try and stick to it, and we've just found over the years the 5 years, the 10-year periods, it seems to work. It seems to work well. And so we've just got to make sure that we don't get lost in the fads and the macro kind of ideas, and just stick to applying the process.
What is that process? What's important to you when selecting a stock?
I think the number one thing is, the thing that can kill you is when you get it wrong, as I talked about before, and the balance sheet comes into play. So our first step in the process is financial strength. And if you get that wrong, then all hell can break loose, and there's no stop to the downside for a stock that's in financial pressure. So I think that's a key part of our process.
Is that also key for you?
Oh, I'm a bit more flexible. And Matt's right. The operating leverage and financial leverage on stocks, depending on where we are in the economic cycle, and competitive pressures, industry dynamics that change, that can alter the trajectory of earnings for certain companies. When things turn down, there's operating leverage. But in the cycle we've just endured, where rates have gone up and companies that have got far too much debt and are suffering from much higher interest costs, and then throw in a bit of regulatory risk, Star's a classic example. And we've avoided it like the plague for years and years. And quite frankly, blind Freddie could have seen the train smash there. But that comes down to operating leverage and financial leverage that has seen the stock go from $5 to 28 cents or wherever it is today.
I want to get on to the risks now. You said before that you're cautiously optimistic. What risks do you see out there in the market?
I think the biggest risk is complacency. And this market has been driven by momentum and fear of missing out, and valuations have virtually gone out the window. Valuation discipline. There seems to be this mentality of sort of buying stocks with this growth at any price mentality, and I think at some point that will bite a lot of people on the bottom. And I think ultimately valuation is paramount. And Matt talked about management, and management getting things right and executing well. And there's a lot of companies that have executed well, where management have nailed it, and others that management have got it horribly wrong, or the board has got it wrong, and a lot of those stocks are in the toilet. Now, some of those will be some of the best buying opportunities you've ever seen in your life. Others, like a Star, the rest is history. So where's the risk? I'd say the risk is valuation risk. And as I said, 24 times non-bank industrials, it sort of cuts against my cloth a little bit. As long as the earnings come through and the stocks trading on premiums to that multiple deliver the earnings growth and the revenue growth that the market is expecting, that'll be okay. It's only when they're priced to perfection and it's a crowded long, and I always avoid the crowded longs. It's something I've been pretty good at, and there's a lot of them that if they miss their numbers, that's when those stocks get absolutely poleaxed.
Okay, over to you, Matt. Other than valuation risk, what other risks do you think investors need to be aware of? Yeah,
I think Chris nails the complacency. I think at this point, when you've had such a good run, the market's been great, right? And it's always a great place to be. You've got to be in it to win it. You can't try and second guess it and macro call it. But I think it's a good opportune time, given the strength that we've had, is just to check your portfolio, check the stocks you own, and whether you've maybe become a little complacent. Are you in just the high octane stuff? Has your portfolio shifted over the last few years? Gradually to a point where you're carrying some unintended risks. The other thing is that investors should always be set so that if the market does suddenly fall 20, 30% very suddenly, that they do not become forced sellers. That they can hang on, and if they're lucky enough, can actually add to their add to their positions.
That was an awesome piece of advice. Chris, do you have anything to add?
Yeah, I was just going to add to do your own homework and not follow the sell side recommendations, which is always fraught with danger. Do your channel checks, check with other companies to make sure what company A is telling you is not a furphy. But the thing that bugs me the most about the market behaviour currently is sell-side analysts just chasing the share price down in terms of their target prices and recommendations, or chasing them all the way up. After they've gone up 50% or 100% with the stroke of a pen, they upgrade their recommendation and target price. I mean, that's not the way Matt and I invest. We can't just with the stroke of a pen just say, well, we've missed the last 100%, we'll just put it on the buy now. Magic.
Okay, to finish us off today, I want to know where you're both seeing the most opportunity right now. You've talked a lot about stocks that are undervalued by the market. Maybe they've been really beaten up. Do you have an opportunity like that for us today?
Well, my table thumper, and it's probably controversial, it's probably one of the most hated stocks in the marketplace. It's in the financial sector. It's Insignia, and you look at the share price performance over the last decade. It's gone from $13 to a low of $2 and back to $2.68 or $2.70 or wherever it's trading today. Now look at the market cap, and it's 1.8 billion. Just to remind your viewers that they paid $1.5 billion for MLC, and they paid $1 billion or thereabouts for OnePath from the ANZ a while ago. And again, it gets back to management misstepping, and recently they misstepped with the dividend pause. Now, that upset the apple cart and surprised us even as investors. But then I take a step back and I can sort of now see why they did it. They were worried about the timing of their cash flow and the timing of cash payments for previous remedial action. And there was a class action which they actually just settled last week with Slater and Gordon, and it was a $22 million outlay. Maybe they didn't know the extent of the class action liability and whether it was going to be 100 million or 200. So they paused the dividend. The stock was $2.92 before the result, crashed 25%. It's now recovering. I could see that stock, I'm going to say it, double from here. I'm not in it for 5 or 10 or 15 cents. I look at the multiple it's on probably 7.7 times PE. All its peer groups, look at, it's not apples and apples, but Platinum's on 13 times, Magellan's on 13 or 14 times. AMP, that's such a good brand, isn't it? That's on 14 times. This thing's on 7.7 times PE. They pause the dividend. We would be hopeful that they'll reinstate the dividend at the next result, fingers crossed, but I don't know. That's up to the board. We'll see. And then I look at other platform businesses like Hub and market darlings like Netwealth on 55 and 60 times PE, when, they've been growth companies, but half their profit plus comes from the cash margin. And in 6 months' time, the RBA is going to be cutting rates, and those stocks are going to become downgrades. And on 55 and 60 times PE, I think personally they're the best shorts in the market. Okay. Not allowed to short, but if I could, that'd be the first two I'd put on.
Okay, over to you, Matt. Where are you seeing the most opportunity today, and can you give us a little stock pick? Yeah,
sure. So I like BlueScope, and I guess it shows Chris and I's, sort of philosophy. This is another single-digit PE company. And look, the thing I like about it is that it's actually in a tough market right now. We're not buying this at a cyclical high. Steel spreads are under pressure both locally in Australia and in the US where they have operations. So I sort of like that. How long they're under pressure for, we don't know. But the company is spending money to increase capacity both in Australia and the US. They'll probably get good returns on that over time. And the management team has just been excellent capital allocators. They've bought back a lot of stock over the last 5 years, very quietly. And so we think this is and the balance sheet is excellent. So we think no matter what happens sort of in the market, this company should outperform going forward over the medium term.
Could it double like Insignia?
No, probably not in the time frame that Chris has specified for Insignia, but I think it's a very good 3 to 5 year stock for sure.
Okay, well I hope you enjoyed that episode of Buy, Hold, Sell as much as I did. If you did, why not give it a like? Remember to subscribe to our YouTube and podcast channels. We're adding so much great content just like this every single week.